to another exciting episode of Finance Footnotes. I am your host, Brent Stransky, joined, as always, by my friend and colleague, Zach Miner, on Finance Footnotes, where we peel back the layers a couple levels to look a little deeper into the mist and determine what we can do with our finances to have better outcomes. So the next two ideas I want to share with you are two, I say, these are graduate level concepts in finance. I'm going to approach them from a high level because I think they're valuable, but I think it's going to indicate where things go. Emily, the Federal Reserve is going to release some meeting notes. And I think a lot of what's happening, Zach, and I'm sure you'll agree, what's going to happen with the Federal Reserve interest rate policy, right? You've probably heard a lot about that, folks at home. And so this really great graph here from the Wall Street Journal last week. And it's kind of measuring over the last 10 years what's this mystical thing called neutral rate? And Zach, please feel free to chime in here. But it's interesting because I haven't actually seen it be represented as a band before. So the orange is showing you kind of the upper estimation of the band, and the blue is showing you the lower estimate. It's not necessarily a known entity, right? This is always a guess. What
Correct.
is the interest rate where the economy is neutral, right? Where if you had interest rates above that, it would be restricting the economy. And if it was below that, it would be encouraging economic growth. So right now you can see that the band has been moving around a bit over the last 13 years. And you can see that it is cutting down towards the upper expectation of what the neutral rate is. So I guess the thought is, we are becoming more accommodative, although it does seem like the upper bounds seem elevated. So I think all that to say that it looks like we're getting more accommodated over time, maybe 2 rates cuts this year. I thought it was pretty graph, Zach. What do you think?
Yeah, like it represented as a band, and the neutral rate is essentially when the Fed is just kind of hands off, letting the economy do its thing. They're not restricting or not attempting to restrict the economy or attempting to stimulate it. It is Fed Day today in about 53 minutes. They'll
Fed Day.
their...
Zach's kids get presents on Fed Day. He's very excited.
Yep.
Right.
And the expectation is that there won't be any moves today, that they'll hold rates steady today, and like you said, the expectation is down towards about 2. I still think that this type of chart where the expectation for the neutral rate is increasing still will leave room for my prediction to eventually come true, that they will raise the target rate of inflation in the economy from 2 to 2.5% at some point in the future. And then I'm going to stick to that until I'm proven otherwise.
I think that's reasonable. I'd like to start with a cause for concern, right? And then I'll end with a couple ideas for optimism. But this also printed in the Wall Street Journal this week. And it's the second advanced financial concept. I don't mean to bore you folks to tears, but if you're at a cocktail party and someone brings up the equity risk premium, you can walk the other way. But for our sake, let's just quickly talk about it. This is essentially taking the inverse of the price to earnings ratio and subtracting out the treasury yield. It's a lot of gobbledygook to say, hey, is it better to invest in a guaranteed interest rate from the Federal Reserve, or does it make sense to take the equity risk premium, the risk in stocks, right? So, you can imagine if the interest rate was 10% on the treasuries, a lot of people would be investing in bonds instead of stocks. And the reverse is true. So I just wanted to highlight this really important fact here that was interesting, that it's turned negative for the first time in 23 years, which indicates that future stock market returns will be muted. If history is any indication, which it isn't always, but it's reason to have our ears to the ground, looking for alternative investments that can, perhaps have better optionality over the coming decade. So, surprised to see that.
It could mean that. It just means that on a relative basis, stocks versus bonds, which are more attractive from a risk adjusted return perspective. And when it's negative, that says that the bond market is more attractive. So that would indicate that for balanced investors, growth and income investors, that having fixed income and bonds in your portfolio is once again potentially a good thing. Where for 10 plus
5
years,
or 10 years,
it wasn't really doing anything for you, right? It was really just kind of sitting there, and would bolster an equity market decline, but that was about it. You weren't really earning much from it. And now you're earning, an excess rate of return above inflation, and a real return on fixed income. So
yeah,
that's
Zach,
what I'm saying. Yeah.
You bring up a great point. And typically when the equity risk premium is high, it's suggestive of better returns going forward. And maybe there's less correlation if the equity risk premium is low or zero in this case, or negative in this case. Maybe it's just less correlation. But so our friend Ryan Dietrich. See him on Twitter sphere a lot, and he had this really great chart. And it's showing the last 10 presidential cycles, the last 40 years, 9 of the last 10 were positive in the first year, and it tends to be the best year if you look at just the last 10. So this post-election year, 2025, if we're just looking at this one statistic, 10 observations, 9 of the 10 were positive, average 18% return. Pretty impressive. We'll have to see if that continues. All right, so cool. Second, that first one, easy to follow along with. Typically, the first year of a full presidential term, for example, 2025, is quite good for the markets typically. Second one, more complicated. I'm sorry. I guess just to say that the VIX was very choppy at the end of December. That's unusual. One day it was up 70%. On the 18th, that was when the Federal Reserve made an unexpected announcement about interest rates, up 70%. But then but a month later, it was basically flat. Okay. During this time, it was going down, realized, okay, actual volatility ticked up. So you had this kind of inverse where expected volatility measured by the VIX was decreasing while realized volatility was ticking up, right? Very, very unusual. This was in Barron's this weekend. Since 1990, when that's happened, the S&P is up on average 13.5% over the next 12 months. This could be, looking at the minutia and the tea leaves, and there's no real, evidence that it could go up. But I think this move in the volatility markets has, at least over the last 35 years, indicated that stocks are poised for a rebound over the next 12 months.
Sure.
My gift to you, my friend. Well,
Love it.
that wraps us up here at Finance Footnotes. We'll see you next time. Have a wonderful rest of your week.
Thank y'all. So many nuggets today.